Greg, I think you're in the pause, we're done camp. Either they are or they should be. And, it was in response to that ISM services report that we saw, I think, the November rate hike odds jump to above 50%. But Steve's right, Greg, that, we haven't heard officials, I guess, being too, hawkish or kind of running this policy of, well, we better err on the side of one more or else.
Yeah, policymakers are being very careful as to what they say. I think the mot du jour is really going to be proceed carefully going forward. They want to essentially highlight the possibility that there will be a pause, and we think that's going to be the baseline forecast. We think the Fed is done with its tightening cycle, but they don't want to essentially exclude the possibility of future rate hikes should either domestic demand prove stronger than expected or the labor market show less easing than expected. Those were the two conditions that Powell highlighted during his Jackson Hole speech. So I think it's going to be a nuanced message, but I think really, given what the data is showing, given how inflation has been evolving, how the labor market has been evolving, I think the Fed is done with its rate hike cycle. How
would you describe inflation evolving, Greg? I mentioned a couple of kind of anecdotal data points, but what do you think is really going on here?
I think it's very interesting because there's this debate about the last mile of inflation, getting inflation down from 3% to 2% being the most difficult. I'm not necessarily sure that that's the case. We are seeing evidence that a number of inflationary measures, inflationary gauges, are pointing towards faster disinflation than initially expected. You're seeing that the housing disinflationary impulse is going to accelerate. That's going to put downward pressure on core inflation. You're seeing PPI inflation also on the downside. You're seeing import price inflation on the downside. You're seeing wage growth evidence also showing more signs to the downside. So I think inflation will continue to slow in the coming months. It will be a bumpy process. We know higher energy prices are going to disrupt the momentum over the next couple of months. But as we move into 2024, we see slower economic activity and stronger supply. I think that's going to continue to put downward pressure on prices, and businesses will be looking at inflation no longer as a one-way bet, but really thinking hard about their pricing strategy in this environment.
Absolutely. That's a whole other chat about earnings as well. Steve, what would you add?
I would add that, look, the market has this binary idea about the Fed. They're either on or they're off. In other words, they're either hiking or cutting. The Fed does not want that to be the set of choices that the market is embracing. And one of the reasons why they keep hope alive that there could be another rate hike is because they don't want the market to start pricing in cuts right away. They do not want to have the added stimulus of rates coming down. Now, I think that it would be a wonderful thing to happen in the sense that you might get a positive slope to the yield curve, which I think would help the economy in all sorts of ways. But that's one of the reasons they keep that idea alive, is because they don't want you to think about cuts. If the Fed could get the market to trade with nuance, it would welcome it, but it can't.